This is Taking Stock on Bloomberg. I'm Pimm Fox. Investors are always seeking new opportunities for profit. My next guest is a firm believer in fixed income strategies, but he's got some insights that may surprise you. Tad Rivelle is the Chief Investment Officer at Trust Company of the West. His TCW Strategic Income Fund has outperformed 91% of its peers. That's over the past 5 years. I want to welcome you, Tad, to Taking Stock here on Bloomberg.
Thank you.
Now, in our discussion just before you came on, we're talking a little bit about the Treasury market and how many people view the Treasury market as a risk-free investment. Not so if you have to subject yourself to the possibility of interest rate increases, and indeed there's that duration at risk. Explain a little bit more.
Well, as you point out, treasuries don't have any credit risk associated with them, but they do obviously have interest rate risk associated with them. And at 2.5%, there's precious little cushion for the potentiality for investors to evaluate their belief as it relates to this notion that inflation is dead in the U.S. or that economic growth is dead. And if you don't accept either or both of those theses, I think it's very hard to accept the fact that there's any value left in 10-year treasuries or indeed the treasury market as a general rule. So as a for instance, we have been printing consumer price inflation at under 1% over the course of the last 12 months. Were there to be any increase in that level of consumer price inflation, I think investors would most likely want to be selling off their treasury securities, pushing the yields higher, and of course, as a result of that, sending the bond prices downward, and therefore generating poor investment results for the owners of those treasury securities.
Well, you bring up an interesting point, because it doesn't necessarily mean that the Federal Reserve has to do anything for interest rates to increase. It could be that there are blocks of investors who decide, no, I don't want to hold this 10-year Treasury note and get 2.5% for the next 10 years. I want to sell it. And that selling, if big enough, could precipitate an increase in the yield.
Yeah, well, I think whenever you look at an investment, you have to be evaluating your upside versus your downside risk. If one considers the example of Japan, over the course of the last 20 years, everyone is familiar with the economic malaise, the deflation. Even in that harsh environment, that harsh economic environment, their 10-year rates were maybe as low as about 1%, but most of the time somewhat significantly higher than that 1% level. That suggests that the 2.5% 10-year Treasury has at best maybe 100 basis points of additional rally associated with it. On the other hand, it was only, let's say, in 2006 when 10-year Treasury rates were somewhere in the order of 5.5%, 5.75%. So that tells you that there's certainly potentially much more risk of Treasury rates rising in the event that an economic recovery ultimately takes hold, or perhaps in the event that there's some uptick in the rate of inflation, which we think is actually probable over the course of the next 12 to 24 months.
Now, before we get to those 12 to 24 months, are we going to have another round of quantitative easing, another round of the Federal Reserve going in and actually buying up U.S. government debt?
Well, it certainly seems that the body language that's coming out of the Fed, many are, I'm sure, familiar with the statements that were made by the New York Bank president this past week that I think were suggestive of the idea that there are many inside the Fed and many of the influential members of the Fed that are of the view that an additional round of quantitative easing is a worthy pursuit given the anemic pace of economic recovery. As again, many of the viewers are all too familiar with, and as the Fed has propounded on, the rate of economic recovery as measured by job creation is running at maybe 1/3 the normal rate that we've seen in the post-World War II experiences. It is an exceptionally weak recovery, and I think the Federal Reserve is quite rightly looking for ways to potentially continue to prime the pump.
All right, so taking into account the risks that Treasuries pose at 2.5%, and taking into account quantitative easing part 2, QE2, where do you go to make some money right now? You were just telling me non-agency mortgages.
Well, and the reason for that being is that even though bonds oftentimes get lumped as a single entity, one will remember that in 2008 there was massive decoupling between bonds, let's say the Treasury asset class, which had its day in the sun. It wasn't actually quite done at that point in time. And it was the riskier asset classes, high-yield bonds, non-agency mortgages, and investment-grade corporates that had such a tough time in 2008. As we look forward into the environment in front of us, it is our sense that, in all likelihood, the Treasury rates have gone about as far as they're likely to. It's not inconceivable that they could continue to rally further and rates could go lower. But if you're looking for opportunity in the fixed income asset class, there's still abundant opportunity in non-agency mortgages where it is possible to earn 8, 9%, maybe even 10% loss-adjusted rates of return on senior certificates, senior classes of non-agency mortgages. And the high-yield asset class, I think, is also interesting. Spreads of over 600 basis points to Treasuries and all-in yields of 7.5% against the backdrop of a CPI environment, an inflation environment that, while very benign, and even if it becomes incrementally worse, is still suggestive of high real rates, inflation-adjusted rates of return for the investor.
What's the biggest risk for non-agency mortgages? Would it be prepayment risk right now?
No, indeed, there is virtually no voluntary prepayments that are being made, and it is your question is right on point, because the usual risk that the investor underwrites when he owns a non-agency mortgage, or indeed any mortgage-backed security, is the risk that prepayments will rise or fall in a manner that is helpful to the homeowner who possesses the right of prepayment and harmful for the bondholder who's on the other side of that. In the current environment, the primary risk that one runs in owning a non-agency mortgage is the potentiality of a double-dip recession. We don't think that that's likely or probable, but it is a possibility as we look into 2011.
All right, I want to thank you very much. I hope you'll be on before that actually happens. Keep us up to date. Tad Rivelle, Chief Investment Officer at Trust Company of the West, giving us some details as to the fixed income markets. Thank you very much.